Hello and welcome to the Advance Your Wealth podcast and video series. I'm excited to bring on a special guest today, Jason Buck from the Mutiny Fund, to talk about all things long volatility and the Dragon portfolio. If you watched our quarterly investment themes video we just put out recently, you heard me talk about this whole idea of the death of the 60/40 portfolio and some of the asset classes that would make sense to be adding to your investment portfolio given that likelihood coming. And so one of those asset classes was long volatility. And so I wanted to bring Jason Buck on, who's one of the industry leaders in this space, as well as the whole idea of the Dragon portfolio in general, to try to help you understand this or think about this and how you should be thinking about this for your investment portfolio. So with that, Jason, maybe just a quick introduction of yourself, how you got into this whole long volatility Dragon portfolio space, and we'll kick it off from there.
Great. Thanks for having me on, Homer. I always enjoy talking to you, so I'm really looking forward to this. So basically, I'm the CIO and co-founder of the Mutiny Fund. We specialize in long volatility ensemble approach to markets. We also focus on building holistic portfolios for our clients. So I'll take a step back for a little bit. Coming into 2007, 2008, I ran a commercial real estate development company. And, as that liquidity dried up in 2007, 2008, I figured there had to be some way to hedge some of my entrepreneurial or global macro risk. So essentially, when we own a business or we own real estate, we're long GDP, right? The way of saying that is you're long the good times, right? As long as volatility is suppressed and you hope the future is better than the present, you're hoping that, the economy is awash in liquidity. It's just those good times roll. And so as an entrepreneur or as a commercial real estate developer, if your projects you're looking 2 to 5 years out, you actually want volatility to be very suppressed, very tamed. You want the future to look like the present. Therefore, we're long GDP in those kinds of environments. But every once in a while, like in 2007, 2008, as we just saw in March of 2020, when liquidity dries up, it doesn't matter how good you are idiosyncratically as an entrepreneur. If liquidity dries up and things come to a halt, you have problems. So we use that GFC as an impetus of there's got to be a way to hedge some of that entrepreneurial risk so that way we can invest more in ourselves. So this has been a better part of a 10-year project of thinking how we could open up an investment theme like that to other investors. And so I've traded options for the better part of 2 decades. I've traded the VIX since 2010. I developed VIX arbitrage models for a family office. So I've been in this space for a while, and I was working on this specific idea of hedging my own entrepreneurial risk. But for the last 5 or 6 years, I've also been tracking the other long volatility or tail risk managers in the space. And so I got to the point where I had family and friends coming to us and asking, I get it. I've read a Nassim Taleb book. I've read a Chris Cole white paper. How do I protect myself? And I go, do you have $150 million? And no. Well, you're screwed, right? There is no option for retail. So as entrepreneurs, we just figured there had to be a solution. And so we've spent the better part of the last few years coming up with that solution and building an ensemble approach to long volatility and tail risk and being able to provide that to accredited retail investors. And that's kind of the backstory of how we got here with Mutiny.
So real quick, just to dive deeper for some of our clients who may not fully grasp all of the concepts here. So what is the VIX and writing options on VIX? What is the whole idea around that?
Sure. I'll even take a step back for a minute. As I alluded to, when you're long GDP assets like your stocks, bonds, private equity, venture capital, real estate, like I said, all those things are kind of long GDP. Another way we say that is they're implicitly short volatility. You do not want volatility in those scenarios. So the flip side of that is long volatility. What happens when the market crashes or liquidity dries up? Then you're going to see a spike in volatility. And so therefore you're long volatility, and it acts as a ballast to the rest of your implicitly short volatility portfolio. So historically, people have looked at the VIX index, which is colloquially called the fear index. Now, it measures kind of volatility. It's actually a 30-day forward variance look at volatility of what the options pricing on the S&P are showing for the next 30 days, where the market expects volatility to be. Now, the VIX index is a little bit unique because it creates that fear index and it can spike up when there's volatility in the markets, but the VIX index is non-tradable. So the way we're able to trade the VIX index is through futures, but then futures create a term structure to that curve. So you have to be a little bit careful about how you trade those VIX futures. The other way to trade long volatility is by playing in the options market. So there's multiple ways and path dependencies where long volatility or sell-off or a liquidity event can happen. And we try to cover as many of those path dependencies as possible.
And so the idea of long, can you maybe give a couple of examples, like maybe in the real world or maybe in the investment world? You mentioned options. So the idea of an option, premium payment, and payout. So the idea of using options for long volatility, or maybe even bringing a real life example in to give our clients a better understanding of what that means, long volatility.
Sure, I'll give you kind of two simplistic examples. One is you can look at buying options like insurance, right? We all have house insurance, car insurance, life insurance, right? And every month, quarter, or year, you pay that insurance premium. The same way with buying options. You pay that insurance premium to put on a position in options in case volatility spikes or the market crashes, then you get paid out on that option. And you pay that little bit every year in insurance premium. And just like in your car or your home or your life, you're spending a little bit on that premium. So you have a little bit of that bleed. It's like a little bit of paper cuts every year while you're potentially waiting for that future event, that unknown event that can happen, and you have your insurance in place. That's the way you could just, a vanilla way of just buying options is waiting for this liquidity event to happen. Or, typically or historically, the way that it's been done is you may buy put options on the S&P 500 for an attachment point of negative 20%. And what that means is that if the S&P sells off more than 20%, those S&Ps will cover you one for one beyond that point. But every year or every quarter or every month while you're waiting for that to happen, you pay the insurance premium to that option seller. And that's how you can express these trades and options in a very vanilla way. The other way you can express this trade is on the VIX index. Like I said, the VIX index is non-tradable, but we have a VIX futures term structure. So you could go long that front month VIX futures contract, and that would be if VIX spikes, you would be long that front month VIX futures contract. So as you're riding that spike up. Now the difficulty is that term structure creates a roll down effect, where if you're long that front month VIX contract, you're gonna get bled out as well on the roll down of that futures curve. So those are the kind of two vanilla ways to play long volatility or with VIX or options. But then there's other ways to kind of hedge that risk out, so that way you can hopefully carry that position for years on end while you're waiting for that event to happen.
So the idea is, paying potentially a small premium up front with some asymmetric payout that might come when you need it the most. To your point earlier on the entrepreneurial put, is you have liquidity when others may not have it, or when it's drying up. Is that right? Is that kind of a very, very quick way to say it? I heard Diego Perea have an idea on a podcast where he mentioned the idea of books, and that with books, it's kind of like an option where you're paying a premium, the price of the book, and that, no one's forcing you to read it. So it's not, you don't have an obligation, you have an option to read it. But the ideas you might get out of the book might create some, huge payout in your career and life, right? And so it's got this asymmetric upside to it. And he was kind of describing that as another real life example, kind of to the insurance point of long volatility. Does that make sense? Is that another way to think about, or maybe that's just options in general versus long volatility, but how do you think about that?
Yeah, to extend maybe Diego's metaphor too, is like you may read hundreds of books that give you no ideas or no payout. And it's just that one sentence in that one book that changes your life. And that's kind of the way of maybe paying those premiums and options. The other way to think about it is Nassim Taleb talked about the turkey problem, is that, to a turkey, his life looks fantastic. The farmer's feeding him every day for 1,000 days. And the market for the turkey just keeps going up until Thanksgiving comes and he gets his head chopped off, and then it all goes away. So the way to kind of look at the world through implicit short volatility is those long GDP assets is we're making small gains until that liquidity event happens. As they say, the market takes, the stairs up and the elevator down. Well, it's the exact opposite a lot of times for long volatility and tail risk, is you're taking those small paper cut bleeds, and then you have this huge asymmetric upside when the market tanks off. So pairing the two is what allows you to compound wealth efficiently and effectively over the multiple business cycles of your lifetime.
Cool. That makes a lot of sense. So bigger picture, thinking about this idea of the death of the 60/40 portfolio and the dragon portfolio concept. I know you've spent a lot of time studying that whole idea for many years, even before the Chris Cole paper, Allegory of the Hawk and Serpent. So take me through that line of thinking. I've not only seen that from the likes of the long volatility, portfolio managers. I've seen it a lot now, getting a little bit more into mainstream media here and there. So walk me through why people are saying the death of the 60/40 portfolio is coming, and how the concept of a dragon portfolio is potentially the right solution for what we see coming forward.
Sure. I think maybe I'll start with 60/40. We've been in this, 30, 40-year bull run on the bond side, right? And so every time the market sold off, the Fed steps in, and therefore your bonds have acted as a ballast. As we get towards this zero bound, or even if we go negative, now you have it's very similar to the put option, right? You have that negative premium payment that now you have with bonds or are about to have with bonds, but you also don't have the convexity of the upside as you would have with options. So we've been in this unique period or time frame where you've had this negative or uncorrelated nature between stocks and bonds in 60-40. But if you look at a 200-year history of stocks and bonds, they're actually more correlated than they are uncorrelated. And we just haven't seen it since the 70s when they became incredibly correlated and the 60-40 portfolio got just completely burned in the 1970s. Example is in the early 1930s, you had a 63% drawdown in a stock bond portfolio when they were correlated a 60-40 portfolio. So the idea is, those are only two pieces to an overarching portfolio that you're trying to build, a holistic way of compounding your wealth effectively and efficiently with low drawdowns over time, because drawdowns act as a volatility tax. The less you can move those drawdowns up, the more you can compound wealth over time. So it's not necessarily about returns. It's about the volatility of those returns and the drawdowns. And they act as a volatility tax. If the S&P sells off 55% in 2008, that's a massive tax on your wealth. And it's going to take you a long time to make up for that. So there's a long history of holistic portfolios going back to the Talmud that says, hold the 30-year assets each in business, real estate, and cash. Then you had Jacob Fugger, which in 15th century Germany, people say if you walk forward to inflation, he was actually the richest man that ever lived, worth like $400 billion. He had the same things in the third as well, from cash to real estate to merchandise. And then if we come forward to the 1970s, Harry Browne had this great idea of a permanent portfolio. And a permanent portfolio was a quarter each in stocks, bonds, cash, and gold. And the idea around Harry Browne's thinking was that there's only 4 global macro environments. There's inflation and deflation. There's growth and recession. And the gold was for inflation, bonds are for deflation, stocks were for growth, and cash was for recession. Now, Ray Dalio of Bridgewater fame took that idea from Harry Browne and he created his all-weather portfolio, where all he did with risk parity was to leverage up the bond side to make the risks even. So that he didn't, give credit to Harry Browne, which he should have, but that's where Dalio's approach comes from. And then recently, Chris Cole came out with the Dragon portfolio, which is really a modern interpretation of permanent portfolio, which is very similar to the way we look at it. Is, now instead of having the cash and gold portions, you might want to replace some of that cash with long volatility and tail risk. It allows a better ballast maybe to the stock portion of the portfolio. And then for the gold portion of the portfolio that's supposed to hedge inflation, you might want to be a little more dynamic and use commodity trend strategies where you can be, hedged with a lot of different commodities and even interest rates, gold, energies, softs, et cetera. So that way you never know where inflation is going to come from. So if you were only holding gold, you may not hit that inflation target very well. I mean, I think gold has had amazing purchase power parity going back 5,000 years. But if in any intervening year, it might not provide the ballast you're looking for. And in, say, March 2020, gold can get sold off just with everything else, just because everybody's going to cash. And therefore, if you're worried about inflation risks, I think you need a more dynamic hedge. And that's where you'd use commodity trend. So once again, going back, it's just 4 pieces to a portfolio that are basically, 4 asset classes that have a different set of return drivers. And you're balancing out the stocks and bonds, which are implicitly short volatility, with longer volatility trades like tail risk, long volatility, and commodity trend.
So Dragon portfolio, kind of a funny name for a portfolio strategy. I know reading the allegory of the hawk and the serpent, even for me, it took me a few times to really get my mind around it. In as, I guess, simple a way as possible, can you walk me through the idea of the serpent and the hawk and kind of what how you get to the name Dragon portfolio? I know this is Chris's work, but I know you've studied a lot, so it could probably be a good resource to help us understand that a bit.
Sure. So going back to these ideas, like I was saying, of implicit short volatility and long volatility, that's how Chris breaks out kind of his 2 wings of his hawk and serpent portfolio. And as I alluded to, the way Chris built it is, if we look at it in a simplified framework, it's 20% each, 20% stocks, 20% bonds, 20% gold, 20% commodity trend, and 20% long volatility. And that's the holistic Dragon portfolio. And the idea being is, during the good times, these long GDP times, you have stocks and bonds that will do exceedingly well. When you have these liquidity events or you have a higher inflation environment, that's when your long volatility and your commodity trend will do well. Now, the way Chris and I talk about this often, and we look at gold similarly yet differently, the gold portion to us is a way to hedge your fiat risk. So typically, if you're building generational wealth, you're not actually going to get burned quite as often by the markets. What's really going to destroy generational wealth is a fiat devaluation or hyperinflation. And so we look at the gold piece as your hedge against your fiat risk. Because going back, like I said, it has a 5,000-year history, but in any intervening decade or few years, it might not provide the ballast you're looking for, but it has tremendous convexity if you have a massive fiat devaluation or hyperinflation event.
Yeah, and then from again, from the names of the portfolios, like the Serpent is kind of an idea. It's like the 60-40, right? So the Serpent part is kind of the 60-40 portfolio. The Hawk is these long volatility commodity trend. Gold is these other pieces, and it's, I guess more from a figure standpoint, the combination of the Hawk and the Serpent together is that creates this dragon, right? I think that's effectively, so people just hearing the dragon portfolio name, again, it's kind of a funny name, but it's really this combination of the Serpent portfolio, which is 60-40, and the Hawk portfolio, which is all these more long volatility commodity trend and gold strategies to kind of help with secular change that we might see coming. Is that a good quick way to say it?
Yeah, that's a great way of saying it. I think the other way we look at it is, that classic 60-40 Serpent of the stocks and bonds are very convergent trades, meaning they're mean reverting trades. And then the long volatility tail risk and the commodity trend are divergent trades, meaning they break out when you need them the most. And it's that combination rebalance frequently, which helps you compound your wealth. Now, the most interesting piece we've always found about a holistic portfolio construction like this is that behaviorally, it's very hard for people because there's always at least one bucket of those asset classes that you hate. And all the news media is telling you it's dead. It's never going to come back. Why would you ever own this? And this is the point. It's a form of epistemic humility to know what you don't know, right? And that the future is uncertain. So therefore, you never know if it's going to be inflation, deflation, growth, or recession. You need pieces of your portfolio that can handle all of those well. And if you're rebalancing frequently, you're basically scaled trading the equity curve of each of those asset buckets. So over time, you're taking from your winners and giving to your losers, and you're building up that position where you need it the most. Now, a lot of times behaviorally, that's very difficult for people to handle, but that's the right way to manage your wealth over the long term.
And the way I was just talking to a colleague about this, and we manage wealth for hopefully multiple generations with our clients. And history has shown that wealth transfers don't typically succeed beyond the second generation. And it's lack of communication, it's lack of preparedness, it's a lack of a purpose or a mission in the family wealth. But I also like the idea that they don't have a 100-year vision for the money. And this whole concept of a permanent portfolio or a dragon portfolio is a portfolio that can stand the test of time for 100 years. And so it just fits with this long-term wealth preservation for clients, is that we don't need to change our strategy based on the shift in generations of who's owning the wealth. We have a strategy that we can stick to over the course of time. Is that a good way to be thinking about it?
Exactly. And I know from personal experience. So my father was third generation wealth, and like the typical third generation, he blew that wealth, right? So I was starting over from scratch. But to me, I love that entrepreneurial edge I have from starting from scratch. But it's the same thing. I've spent my whole life thinking about how do you manage wealth for the long term? How do you create multi-generational wealth? And part of the issue I usually take umbrage with is the idea of investments, right? These things are really savings at the end of the day. And we have to be very careful about our vocabulary, right? You work really hard and you create these dynamic businesses that allow you some leftover savings after consumption, right? And so you build up those savings, and what you really need is those savings to be there when you need them the most. And you never know when that's going to be, whether it's going to be a year from now or 100 years from now. So if you can build these portfolios that aren't stock or stock bond centric, that are much more holistic and that are absolute return, and they're trying to, like I said, reduce that volatility tax, that's what's going to help you compound wealth efficiently and effectively when you never know which year you're going to need access to those savings. But by saying investments, that's how we maybe trick people into taking too much risk with their savings.
Yeah. And so kind of thinking about pulling this all together, most clients think they're diversified if they've got large cap stock, small cap stock, international emerging markets, corporate bonds, government bonds. And so they think they're diversified. But in reality, to your earlier point, they're all correlated, especially at the worst time. And so they effectively become short volatility trades. So talk to me a little bit the advantage of, or how these other more long volatility strategies or commodity trend are non-correlated. It's not even lower correlation, but actually non-correlated, and the benefit of adding non-correlated assets to a portfolio.
Exactly. At the end of the day, they have, the colloquial phrase is correlations go to one. And we only see those in liquidity events like we just saw in March 2020. And so the way we like to think about portfolio construction is you actually have three correlations, right? You have correlated, which are your stocks, bonds, PE, VC, real estate are all correlated, or they're correlated to your equity beta. Uncorrelated is going to be your commodity trend. Those divergent trades that are kind of trying to take advantage of trends both up and down, they've historically been uncorrelated. And that just means they can sometimes move up or down, but they're not specifically correlated with the equity beta. And then you have negatively correlated assets that you have with tail risk and long volatility, because it's in the structural nature of putting on those options trades as insurance, or those VIX trades allow you to structurally create negatively correlated bets against the equity beta. So once again, you have these long GDP assets like stocks and bonds are going to be correlated. Your commodity trends uncorrelated, and your long volatility and tail risk is negatively correlated. And that combination of a portfolio is, like we said, you want that to be there when you need it most. And a lot of times it's just waiting in the wings. In this last cycle, we went 12 years until you could see a real great payout in those tail risk options. But in the intervening time, people have moved away from just buying those tail risk put options and created this concept of long volatility, where you're trying to dynamically use your algos to trade in and out of the markets, both on the right tail and the left tail. So like we're seeing now with S&P up and VIX up, you could see a melt up in the markets, and long volatility managers are trying to also time those melt ups in the market. So that's really the difference between long volatility and tail risk. Tail risk is more historically been just buying that insurance. Long volatility is trying to time the volatility of the markets on both the left and the right tail.
Cool. And think about it from a performance perspective and why it's important to have these non-correlated or negatively correlated assets from a performance standpoint. So you've done a good job explaining this in videos I've seen of yours in the past of this whole idea of looking at things, the arithmetic mean of an asset class or an index, and that most investors don't actually get that arithmetic mean. So can you walk me through what you mean by that and why that's misleading when you're looking at the performance of an S&P 500 versus what you might be getting in your own portfolio?
Sure. What the arithmetic mean is doesn't take into account time. And a lot of times when we look at portfolios, we see the arithmetic mean, and that's just what they're trying to show us over the long historic track record of the S&P, but it doesn't take into account your lifetime and your time walking forward. And so what the geometric mean is when you have to factor in volatility. And that's why I said volatility is a tax on portfolios in general. And so the arithmetic mean doesn't account for volatility. So what we end up with volatility is the combination of the arithmetic mean minus the volatility equals our geometric mean. And that's what our compounding actual wealth is based off that geometric mean. And so the arithmetic mean is always going to be higher than that geometric mean because of that volatility tax. As you reduce the volatility tax, you're allowing that geometric mean, or that compound annual growth rate, to get much closer to that arithmetic mean. And so you're closing the delta on that via reducing the volatility tax on your overall portfolio. And I think a lot of people get confused. That's what I'm saying. They talk about investments. A lot of times they're showing you the arithmetic mean of the S&P 500 over the long haul. Well, we're not an average person, right? We have an N of one experiment where we only have this lifetime or our family's generational lifetimes, and we only have one path dependency. So we can't guarantee that we're going to get the same arithmetic mean that the S&P 500 has gotten historically. We have to be much more conservative with how we construct portfolios to reduce the volatility tax and improve our geometric mean.
Well, and even from a short-term perspective, thinking about it, if you're, have $100,000 invested and the S&P in 2008 goes down 50%, you're at 50,000, and it goes back up 100,000 or back up 100%, and you're back to your 100,000 that you had. So your arithmetic mean would show a positive return in that scenario, but your geometric mean would be flat, right? And so having to look at it beyond just that, what's the average return of the index and actually what's happening in your actual assets in your actual portfolio. Does that sound right?
Yeah, it's exactly what I mean. I think that that's what the industry has kind of sold us on, is that, your portfolio should look like the arithmetic mean, but yet it never does, because it really looks like the geometric mean. And that's why we get kind of sold a lot of products that people use to take advantage of our investments, when I really said, if you think about them as savings, you need to worry about your geometric mean over time.
Cool. So, what else, I guess, have we missed around this whole idea of long volatility or dragon portfolio that we haven't brought into the conversation yet today? Anything we've missed?
Sure. I think that part of the way we constructed our Mutiny Long Volatility series is that we built it to scratch our own itch. So my partner Taylor and I were working on these concepts, and we were talking about Taylor was looking to hedge his own portfolio. And so he was talking about a specific manager he was going to put his money with. And so I started pointing out to him that that specific manager suits one specific path dependency. And that's what we find when we look at active managers, especially in the long volatility space, is they have very niche strategies that are taking advantage of one path dependency during a sell-off or a liquidity event. And so because we never know what that liquidity event's going to look like, we wanted to create an ensemble approach. And because we have our own skin in the game, and we actually have our own soul in the game because we have Thanksgiving risk, our families, my in-laws, they're all invested in the fund. And so I'm really worried about when that sell-off happens. If it only happens once every decade, we have to make sure we capture that. And so not only do we think about the path dependencies, and we use managers that trade the VIX complex, we use managers that trade options, and we use managers that trade futures. And we try to do that to create a diverse ensemble of managers to make sure we capture the different moves of that path dependency. More importantly is not only how their strategy works, but it's how they monetize their strategy. So historically, after you see an enormous spike in volatility, it can mean revert just as fast. So you have to make sure you capture and monetize those moves. And that's why we believe in layering this ensemble approach to have different managers with different monetization heuristics to make sure not only are we positioned for when that move happens, but also we monetize that move. And then after we monetize that move, you're able to rebalance with those implicit short volatility assets like your stocks, bonds, and real estate. And that is what really helps you compound wealth. So the advantage of long volatility tail risk is it helps you sleep at night. So take March 2020, for example, as the market sells off completely and fear comes back in the market and everybody's scared. If you have long volatility on the books, one, you're able to hedge that market, hopefully. But second, on April 1st, you're able to rotate all of those gains on your long volatility back into the S&P at a lower NAV point, and then you're able to go ahead and compound your wealth. Now, how many people were willing to buy the S&P on April 1st? Not many. But if you had long volatility and tail risk still on the books, not only were you able to move those gains back over to the stock and bond portion, but then you kept that long volatility on your books in case you had a second or third leg down. And this is what I'm saying. It helps you sleep at night, helps you compound wealth. And that's what works over time.
Yeah, that's what I really love about this whole concept. And excited to have you on today for that. Is there anything going on right now that you guys see? Obviously, perfect timing would have been to put these trades on in March 1st and have that available. And that was kind of a pandemic related issue that such a sharp drop off and such a quick recovery. But are you seeing anything systemic that might be leading to a reason to consider this idea of a dragon portfolio and implementing it on a more full basis going forward? Is there something changing where, we talk about the death of the 60-40 portfolio, but why? Why is that dying, and why should we be considering, allocating to more of a dragon mentality?
Sure. So, we could potentially see, a longer run in the 60-40 portfolio. None of us know when that portfolio is going to have its next big drawdown. The way we built our long volatility is we wanted to have the mandate that we could have it permanently on. Nassim Taleb said on Bloomberg recently, if you don't have portfolio insurance, you don't have a portfolio, and none of us can time portfolio insurance. So this is why we truly believe in the ensemble approach that we built, is because my partner and I wanted to permanently have these positions on, because none of us know when that future drawdown or that liquidity risk is going to take place. I mean, all of us can look for tremors in the market, but timing of it is exceedingly difficult. And so, for example, if you would have had, the positions on going to March, you get that nice payout. Then after March, in hindsight, the thing to do would be able to take off those positions. But that's the benefit of hindsight. You never know if you're going to see a second or a third leg down. The good news, what we're seeing in the markets, that the only thing I can say about on a walk forward basis is that as volatilities come back down from the 80s to now settling around 20 that we're seeing now, that allows a lot of our managers to reload their inventory at cheaper prices. So as you drifted down from 80 to 20, that bleed is going to be exceedingly high, and our managers know that. They're trying to manage that bleed. But now at VIX levels in the 20s on the VIX futures curve, it allows you to kind of reload a lot of your strategies to make sure you have a full inventory on if there's another leg down from here.
That's great. So one thing I'd really love to cover in detail is I work with a lot of private business owners, real estate developers, and would really love to dive a bit deeper on your whole idea of this entrepreneurial put and how long volatility fits into that idea.
So my partner, Taylor Pearson, has kind of coined this term. It's an entrepreneurial put option. And the way Taylor and I like to look at this is we've been entrepreneurs our whole life. We consult and work with a lot of entrepreneurs. As I said, my background is as a commercial real estate developer, was kind of the impetus for this Mutiny Long Volatility Fund. And the idea being is that when that liquidity dries up, we like to have a convex like cash position is the way to look at it. For all of you that have been through multiple market cycles, you know exactly what that pain is like when liquidity dries up and the market crashes. And you know, if you have a lot of cash on your books or this convex cash position that long volatility tail risk can provide, money has a very different value in those environments. So a dollar is not worth a dollar when dollars are scarce. And that's the way we like to look at it. It hedges a lot of that entrepreneurial risk at the global macro level. Now, does it perfectly cover your basis? No. But typically when these, we have these 12-year runs in a long GDP cycle, and then that liquidity dries up and crashes, it usually manifests itself in the S&P 500 and the VIX complex. So that's where you can make those convex returns when you need it most. Now, the best part is you really need those most because then you can either make payroll for an extended period of time, you can buy up your competitors for pennies on the dollar, or even better, you can buy up new real estate positions for pennies on the dollar. So it's really an incredible competitive advantage is the way we look at it from an entrepreneurial perspective, is to have this long volatility tail risk on the books, is you can think more deeply and go more competitively into your idiosyncratic risk. So you can bet more on yourself as an entrepreneur and your skill sets, knowing you're mitigating some of that global macro risk. So when you're thinking 2 to 5 years out, you don't have to think about the global macro environment and a lack of liquidity or lack of credit drying up. You can worry more about how you develop that portfolio, how you construct your business. Those things can work to tremendous advantage if you're hedging out a lot of your global macro liquidity risk, and then you get that cash position when you need it most. The other thing we look at the long volatility and tail risk is that as the world has become much more financialized, it's become more derivative based. And so these liquidity cascades or crashes happen much more rapidly. So previously you had a cash position was your ballast, but it doesn't provide enough ballast anymore. We believe you need to have those long volatility and tail risk options and derivatives on your book so you get that convex cash position that you previously wouldn't have just having cash on the sidelines.
Well, it's a great point too, because when I look at working with our private business owners and real estate developers, because so much of their wealth is tied into this illiquid asset, we try to keep their investment portfolio liquid. But to your point, when these major market events happen, liquidity doesn't mean the same thing in a market portfolio or even a bond portfolio as we saw in March. Can you maybe just walk through that just a little bit? What happens to liquidity even in what might seem like a liquid stock market or bond market when we see everything, correlations go to 1?
Yeah, when correlations go to 1, as they say, that liquidity dries up and it's more liquidity risk than anything. And you don't want to be selling into a lack of liquidity cascade. What I think is more interesting too with a commercial real estate developer or an entrepreneur or a business owner is we walk through this all the time with clients is there's no reason for you to be buying stocks and bonds. You're already leveraged long that long GDP environment with your business, with your real estate, with your home, with a lot of things in your life are already leveraged along that long GDP. So if you then take your savings and invest primarily in stocks and bonds, now you're double and triple leveraging to that market. So when that liquidity cascade hits, when liquidity dries up or the market crashes, now you're leveraged into that. So right when you need the money the most, you're losing the most money with your savings, which you've parlayed into investments in stocks and bonds, which are highly correlated and tied to your real estate and business investments.
That's great. That's a great point and something I think that I'll definitely be spending some time going deep with all of our business owner and real estate clients. So that's a great point. Great. Well, anything else to add before we wrap up today?
No, I think that I always like I said, I fully enjoy talking to you. And I think that anybody that's looking at managing wealth over the long term or generationally, you have to think about very conservatively about how you create a portfolio that can manage any macro environment. We've just, like you said, we've been really lucky those last 40 years. We've seen this boom in 60-40. Can it go on? Sure. But I don't think anybody has a crystal ball. And so we try to build portfolios that can manage in any global macro environment. And I know you do as well. And that's why it's always great to talk to like-minded people.
Oh, great. Well, as we wrap up, I want to thank Jason from joining us from the Mutiny Fund. And if you are interested in this idea of a Dragon portfolio and adding these other types of asset classes to kind of buoy what we've seen in this great run on the 60/40 portfolio for what might be some secular change coming, definitely reach out to us and schedule some time, and we'll walk through your portfolio and how we might be able to talk about how the Dragon might fit for you. So with that, thanks, Jason, for joining us, and we'll look forward to talking to all of you again very soon.
Thanks, Homer.